market's somewhat recovering. Two things have to happen. One, we have to get Powell, the Fed, to be able to pull the foot off the neck and release a little bit of market pressure that has been building up, obviously, for over the last 6 months. That's the first thing that has to happen. CPI numbers, meaning the consumer price index, has to start slowing, and we do have to see a reduction, somewhat recovering. Inflation. Two things have to happen. And one, if that starts to occur over the summer months, which are some of the highest price months of the year in terms of cost and things of that nature, fuel costs, etc., we still have some challenges ahead of us. So the key will be is if they've gone out fairly light on this will be my question is, I still believe we're going to see a hawkish response from Powell in terms of the press conference, which to me is still the scenario that pushes a lot of pressure onto Bitcoin. Now, will we see a little bit of a jump in Bitcoin? It's very possible we will. We'll jump to the charts and break down all of that good stuff today. I want to jump over to a Fox video here that was kind of talking about Yellen and really DC in general, because I think this is a position that DC is starting to frame up to kind of reposition how a recession may be looked at. Let's jump to that clip.
Own definition of a recession, vaguely saying we are in a recession when there is, quote, a significant decline in economic activity that is spread across the economy and that lasts more than a few months. Here to talk about it is Kevin Hassett, former Council of Economic Advisors chair and author of The Drift. Kevin, good to see you. Give me your take that the White House thinks that they can just rewrite the definition of a recession and we're all supposed to take that?
You know, they're trying to get out ahead of bad news, and they're doing so in a way that I don't really think is honorable. The fact is
so pretty straightforward on what they're trying to do here. I think the scenario that you deal with on what they're going with is two things. One, of course, is the situation where the White House is trying to get into a position that is kind of front-running a recession. So obviously the GDP is up to the point to where we do have 2 consecutive quarters. That, of course, is the scenario that is the classical description of a recession. How the White House responds to this, I think, will dictate to markets if the White House is trying to soften this and kind of move into this much more soft approach, which I think will be kind of the narrative of Chair Powell today when we jump into what he's going to be talking about in the press conference. This is going to be a very critical time. So analyzing not only the response of DC into what's happening, and when you think about the response of DC, I want you to think about Janet Yellen. You also obviously are going to look to Chair Powell. And in addition, there are going to be certain Democratic representatives and congressmen that would position this as a softening of the market, meaning that we've maybe got a retracement in terms of our economy and what it might look like going into the midterms. Because all of this, I still believe, is a narrative that is flying into the midterms. So again, remember, do not forget that Yellen really was the one that is playing this down, because she, of course, remember, was the one that said, hey, this is transitionary. It is one of those things that we're just going to see it for a very short time, and obviously their position, and what it might look like going into the midterms, because all of this, I still believe, is a narrative that is flying into the midterms. So again, remember, do not forget that Yellen really was the one that is playing this down, because she, of course, remember, was the one that said, hey, this is transitionary. It is one of those things that we're just going to see it for a very short time, and obviously, and what it might look like going into the midterms. Because all of this, I still believe, a little bit of calm and cool nature is a narrative that is flying into FOMC coming out of DC over the next week that will start to temper, or try to temper, what's really happening. The market, though, I think will be very questionable in terms of how they respond to this. And again, I think all of this really leans in on and hinges on what Chair Powell is going to talk about today in the press conference. Now, a lot of people look at, well, all right, so this is good. I mean, not good in the sense that we've seen now 1.5 points in the last 2 months of interest rate raises. This is going to continue to put pressure on the housing market. We're going to see pressure on the used car market. We will continue to see pressure, I believe, on the energy markets. And more importantly, I think we'll start to see the slowing and the pressure on the jobs market. And I'll show you some of that here in a second. But one of the other things that is kind of playing into this is the EU. Now, again, we look at the European Union and just how many countries are involved in the ECB, and you had the European Central Bank, of course, surprising markets with a larger than expected rate hike. It's first in 11 years. So this was a big deal in Europe. And it is a big deal because when you look at the G20 countries and the global economy as a whole, because now, it used to be, I think, 25 years ago, the United States was kind of on its own in terms of economic powerhouse. There was, most of it was self-bred in terms of supply chain, all those kind of things. We've evolved beyond that to a greater extent over the last 2.5 decades that has pushed us into a very interesting global economic front, which is why what's happening in Europe is so critical. Obviously, we know that from the sense of crypto because we are seeing crypto on a much more global scale. So all these kind of things from a macro side of things do matter. And obviously, what's happening in Europe matters. The ECB is a very important role in the overall recovery of Europe, which will have a huge factor on how we start to see a potential recovery from a recession here in the United States. Now, some of the other signs that you have recessions in play is when some of your best and brightest companies start to miss their mark. And of course, here you have Microsoft, of course, missing estimates, but their stock was up just slightly. But remember, their miss was just by a little bit. Alphabet actually missed by almost 10%, that being Google. So when you look at the stock exchange and just some of the major innovative companies that are out there right now, they're having their first real challenge. Remember, we still have a lot more earnings coming in this week that will continue to paint this narrative, I think, of a slowing economy. Now, this is good news and bad news. Good news in the sense that the Fed may pull off the brakes. That is, in my opinion, a good news kind of scenario because it does mean that the bottom might be in. The bad news is that what happens when you hit kind of a crash landing on these bottoms like this, in some cases, it's hard to stop the momentum that is starting to move in place. In other words, Microsoft could see another worst quarter. Meta will see a bad quarter. Obviously, Amazon, Alphabet, etc. will continue to see this. And remember that job numbers always are a trailing indicator, as well as the other big kind of 800-pound gorilla in the corner, and that is housing, which is going to be the real estate market. So all of this, I think, really kind of pins into two things happening, and that is on how Wall Street looks at this over the next little bit. So again, Wall Street rising on Microsoft, Alphabet earnings as Fed decisions looming. Now they know we have the 75 basis points in, and the scenario that's going to kind of play into this overall is going to be questionable, as I said, for how not only Powell softens it up. The question will be, is it hawkish or is it dovish? Does he give us a little bit of a runway that starts to put us in the direction of maybe a recovery and maybe a bottom for the crypto markets and the stock exchange itself? So lots happening. Make sure and get your questions in over on the side. Bitcoin seems to be moving just slightly here, just now clipping over 22. I think we're on the minute. Are we still on the minute there? Yeah, so a little bit over 22, up from about 20,006 today. So some movement here on the news of the 0.75. Again, I think a lot of that was baked in to what's happening within the markets right now. But as I said, don't forget, hit the like button. We love to get your feedback on these kind of pieces. And also, when you guys have questions, because we try to answer as many questions as you can, drop them in on the side chart. Yeah, so we'll try to get a little bit over 22 up on these for sure. All right, so let's take a look here also at inflation, because this is something that was kind of interesting to me. And this was this article by Grid. The great slowdown, why inflation, housing, and the labor market might be showing a recession or something else. And this is kind of the scenario that people are looking at. Is this some other kind of economic slowdown that we have not identified in historic, elements? And this is, I think, what Yellen is trying to get to. It's also, I think, what Powell will try to get to today, around that we even though we have seen GDP, 2 quarters of reduction in GDP, the actual scenario is this whole jobs scenario where we are still seeing jobs holding on, but at the same time still declining in certain sectors. And the sector that I watch more than any is retail. and retail meaning mostly restaurant and retail. Those are the jobs that are really feet on the ground jobs, and they're the ones that I think matter the most in the essence of whether or not we see this recovery start to roll out. The actual scenario, jobs will be a very critical part of this. It also gets into a narrative that I talk about a lot, and that is how this kind of recession could have an effect on the credit crunch. And what I mean by that, remember, stimulus runs out, has been running out. The next layer in is that we get pressure on pricing, which is what we've had over the past several months. And eventually those types of savings and or income start to exhaust. And the next layer to move into that, and we've already shown this with rising credit positions, is a credit crunch. And what I mean by that is that people will revert, because remember, they'll revert to using credit. They will not slow down their spending habits. And in most cases, if you have the White House and all your politicians kind of talking to you that this isn't a recession, don't worry about it, everything's fine. In essence, I mean, it's a little bit irresponsible because it doesn't really give people a full view of what's happening economically. And I think that's the concern that is a little bit more, confusing. They even say it here, this is one of the most confusing times in recent memory for the economy. If you listen to what people say, there's an unprecedented gloom. Meanwhile, employers are hiring at a pace that only modestly compared to massive job gains in the past year. Again, I think this is a scenario because we've already seen it here in the crypto space where we've seen a lot more job layoffs than we've seen job acquisitions outside of Binance, who claims that they're looking at ways to go in and hire more people. And I do think this is one of those kinds of scenarios, and I talk about this all the time, is that you can get into a position where you can really start to really gain some strength in your position around what's happening in the market. I know the Fed is getting ready to go live here in a second, so I want to jump over to that. And it looks like they're getting ready to go live, so let me just unmute that. We'll jump to the meeting real quick. Let me go to a full screen for you guys. Let's listen to what the chairman has to say.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75
accepted that the labor market is tightening
and anticipates
still.
that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
All right, this should be interesting because
recent indicators of
tightening is a
spending
big
and
deal.
production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter.
would agree with that.
Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics.
Yeah, he seems like he is really
Labor demand is very strong,
tiptoeing
while
around
labor
this
supply
too.
remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the range of goods and services. My colleagues and I are acutely aware prices for some commodities have turned down recently. The earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. And we're strongly committed. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the range of goods and services. The target range for the federal my colleagues and I are acutely although prices for some commodities have turned down recently. The earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation.
Just yet with what
We're strongly committed. The Fed's monetary policy actions are guided by our mandate to down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then.
My guess is he's not
We will
going
continue to make our
accept
decisions
that
meeting
we're in a
by
recession.
meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
Rally.
Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves
Yeah, I think you're right.
in unexpected ways.
Jay, is that damage
Inflation
control right
has
now is
obviously
very,
surprised
very
to the
critical.
upside over the past year.
Both from
further
DC and
surprises
also
could
with
be in
what
store.
Chair Powell is saying here.
We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time.
He didn't mention
We are
earlier
highly
that it
attentive
was
to inflation
compelling
risks
evidence is what he's
and
looking
determined
for,
to take
which
the
to
measures
me
necessary
says
to
a
return
lot
inflation
around that
to
they're
our
not
2%
planning to
longer-run
slow.
goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Yeah, not a lot of answers.
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
This will be interesting to see the questions. Geez, everybody had one.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from The Washington Post. Wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any
Yeah.
discussion of a stronger hike at this meeting? Thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases.
So we are
in the
watching,
policy
to
rate that
answer
we've been
your
making. I'd say that we wouldn't
Gid
hesitate
B.
to make an even
We're
larger
watching
move than we did
sentiment right
today
now
if the
today
committee
very
were to
closely
conclude
because
that
sentiment will
that were
be a
appropriate.
big factor. We wanted
was
to
not the
post our
case at this
sentiment
meeting.
data
Very broad
on the
support,
CPI
for the move
after
that we made.
the Fed meeting, so we'll be able
mentioned
to
the
kind of
June meeting.
gauge a
We-
little
we
bit where
had said many
Bitcoin and
times,
crypto in
that
general
we
is
were
going.
prepared to move aggressively, more aggressively, if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
This concerns me a bit in the sense that we might see a 75 come in, maybe even on the next
Thank you so much for
report.
taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the
Still
question
look
is,
fairly
how are we
confident,
thinking
though.
about
I mean,
the
just
path
in his
forward?
stance of
So
where this may be
one thing
going
that hasn't
forward.
changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be
That'll be the
asking
big one.
whether we see
Just how
the alignment between supply and demand
Labor
getting
is
better,
gonna be
getting
coming in.
closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target.
yeah.
And it's also worth noting that these rate hikes have been large and they've come quickly,
Fast.
and it's likely that their full effect has not been felt by the economy. So there's probably
And I think
some
that's the
additional
question
tightening,
he's hitting on right
significant
there.
additional
is
tightening in
is
the
gonna be
pipeline.
a big deal.
So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in
So
8
not
weeks.
necessarily an update on that.
So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now.
A
It's
couple
one that
other
we'll make
tokens
based on
on
the
the
data we
move right
see.
now. Obviously,
And
they're
we're going to be
with
making
Uniswap.
To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Yeah, not a lot of answers.
We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
This will be interesting to see the questions. Geez, everybody had one.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. Wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any
Yeah.
discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases.
So we are
in the
watching,
policy
to
rate that
answer
we've been
your
making. I'd say that we wouldn't
Gid
hesitate
B.
to make an even
We're
larger
watching
move than we did
sentiment right
today if
now
the
today
committee
very
were to
closely
conclude
because sentiment will
that
be
were
a
appropriate.
big factor. We wanted
was
to
not the
post our
case at this
sentiment
meeting.
data
Very broad
on the
support,
CPI
for the move
after
that we made.
the Fed meeting, so we'll be able
mentioned
to
the
kind of
June meeting,
gauge a
we-
little
we
bit where
had said many
Bitcoin and
times,
crypto in
that
general
we
is
were
going.
prepared to move aggressively, more aggressively, if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
This concerns me a bit in the sense that we might see a 75 come in, maybe even on the next
Thank you so much for
report.
taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is,
fairly
how are we
confident,
thinking
though.
about
I mean,
the
just
path
in his
forward?
stance of
So
where this may be
one thing
going
that hasn't
forward.
changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be
That'll be the
asking
big one.
whether we see
Just how
the alignment between supply and demand
Labor
getting
is
better,
gonna be
getting
coming in.
closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target.
yeah.
And it's also worth noting that these rate hikes have been large and they've come quickly,
Fast.
and it's likely that their full effect has not been felt by the economy. So there's probably
And I think
some
that's the
additional
question
tightening,
he's hitting on right
significant
there.
additional
is
tightening in
is
the
gonna be
pipeline.
a big deal.
So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in
So
8
not
weeks.
necessarily an update on that.
So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now.
A
It's
couple
one that
other
we'll make
tokens
based on
on
the
the
data we
move right
see.
now. Obviously,
And
there
we're going
would
to be
a
making
swap.
decisions meeting by meeting. We think
And
it's
again, remember the
we
way
think
they
it's
collect
time
their
to-
data is very unique.
to
The
just go
Fed
to a
does
meeting
a
by
lot
meeting
of surveys
basis and
to
not
collect
provide,
kind of the
clear
temperature of the
guidance
market.
that we had
That's
provided
their
before
data
we went
and their mechanism for being able to really get these readings, especially around the CPI.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need
Ethereum coming in
keep
with a
financial
slight
conditions
move.
tight
Again, these are,
in
I think
order
this
to
is more
moderate
of a
purchasing power and
sideways
bring
position.
inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times, what the economy is going to be doing in 6 or 12 months.
Yeah.
And so to try to predict what the appropriate monetary policy response would be. I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, I would, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in
not a good
weaker
data
than
point.
expected.
Remember, what
But
he
at
talked
the same
about
time, I
earlier
would say
is
that's
that
probably the
these
best
2 basis
estimate of
point
where the
raises
committee's
of
thinking is
0.75
still, which is
are
that
still a
we would get to a
behind what will
moderately
affect the
restrictive level
market.
by
So
the
we
end
could
of this
see a
year,
lot
by
more
which I mean somewhere
CPI
between 3
pressure
and 3.5%.
post these 2
and that the committee sees further rate
interest rate
increases
raises.
in 2023. As I mentioned, we'll
big one.
update that, of course, at the September meeting, but that's really the best I can do on that.
And really, this is
Inflation
definitely
had been
not
little
a
bit hotter,
dovish
than
position
anticipated.
overall,
Has
what
your
he's
view of
talking
the
about.
terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading.
So I
but
think
this
we'll
one,
most
this one
likely see a
was
little bit of
even
a
worse than
correction on
expected, I
Bitcoin
would
tonight.
say.
It'll be interesting to see
I
the
don't
sentiment
talk about my
coming
own
in today
personal
on
estimate
retail traders.
of what the terminal rate would be. I will write down that in. It's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting.
This will be good.
Based on
This
the
will be
data.
good to see it, because this period of time is going to be very critical, because he's right. So much
Hi,
could roll
Julia.
up on here.
Thanks for taking our question. Gina Smilik, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question, and we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC.
Yeah,
Thanks for taking my question, Mr. Chairman.
He knows
Earlier
it's
this
coming.
week, the president said we are not going to be in a
This is a good
recession.
one.
So I have 2 questions off of that. Do you share the president's confidence in not being in a recession?
Finally, somebody
And
asked a
second,
question.
how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth
definitely
of the
has a little bit of a
reopening
nervous
year of
position, and I do think it's still a kind of a scenario where He knows what's
You're
coming.
also seeing tighter monetary policy, and you should see
Just
some
in the
slowing.
lagging
We
side
actually
of
think we
things
need a
of
period
these 2
of
basis points
growth
raises.
below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions.
Yeah.
And those are
That's the
things
big
that
one.
we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
Which I don't see it ever going back there. I think we are in an inflationary period of time. It's just one of those things.
So we're going to be focused on getting inflation back down. And
He's dodging the question.
as I've said on other occasions, price stability is really the bedrock of the economy. And nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do.
Bitcoin is
And we
still
think that
undecided
we don't
on
see it
whether
as
or not
a
this is
trade-off
hawkish or dovish.
with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters.
Might
Quickly, in
happen,
regard to
Brad. We could
expectations,
see that 24.
it's
Remember,
been said
we
the last
did
few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
Okay.
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong
So
labor
they're
market.
clearly
As I mentioned,
denying recession
along with,
at this
in all
point.
likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further.
Ooh, interesting statement.
I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
We're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Yeah, this is going to be interesting because he is right. He's on tightrope.
Neil Irwin from Axios.
Being able to deal with this, I think,
build a little bit on what Steve was asking.
But I feel it's still a little bit of a softer side.
Do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
Those numbers are already.
So, I do not think the U.S. is currently in a recession, and the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market.
I'd love to hear what those pieces are.
As I mentioned, it's true that growth is slowing.
High performers.
And for reasons that we understand, really the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now.
Right now.
Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports,
funny
I think,
numbers coming in on GDP
with a
then.
grain of salt. But of course, it's something we'll be looking at.
Even though that's been kind of the cornerstone of really understanding
Victoria
what
Buda,
the
Politico.
economic position
I wanted
of
to
the US
ask about
is
the new conflict of
over the
interest
past
rules that you all rolled
5
out.
decades.
Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight. That actually you won't be able to make trades unless they're pre-cleared.
No insider trading.
And the amount of trades you make will be,
they'll
have to be 45 days or more before any FOMC meeting. It's just, I think we've really, created a very strong and robust set of rules that will.
They don't seem to be getting into, other than a couple of questions directed at him on the true status of whether or not we're in a recession.
I'm proud of what we did.
They seem to be letting him off the hook a little bit as to whether or not, what is the path forward, how do we deal with the next, and how do we get to 200 basis points before the end of the year?
I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for making the decision on how much to raise rates, and just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So
Noah en Lucas gebruiken eToro om te beleggen in de financiële markten. Noah volgt de feed voor het meest recente marktnieuws. Lucas.
Inflation, and we're going to be thinking about our policy stance.
In Ethereum protocol lands, right, where there's the merge, the surge, the verge, and then a bit lower is going to be the purge and the splurge, right? So the merge is proof of stake, the surge is sharding, and the verge is Verkle trees. The purge is like things like state expiry and like deleting old history, and the splurge is.
In terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be.
Nothing there.
But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think
introduce rather the next panel
is probably the best guide.
Well, Kathy, I just wanted to dispel one question I've been getting
numbers to answer your question
all morning as I walk around the show. People are asking me whether or not I'm still bullish on Bitcoin. And I would like to, just clarify that I am more bullish than ever on Bitcoin. The future's bright. So, we're here to talk about what we see in the future. And you've spent a career in institutional investment and capital.
We've long, used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing
it's
than
the
PCE
normal
index
stuff
does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time. And if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned.
How are you doing?
So we'll be watching both.
I'm not on fire, and so that's good.
Best measure.
That's wonderful. So we're so excited to have you here. We know that you've journeyed, ventured into Bitcoin fairly recently, and we want to ask you all about that.
Mr. Chairman, Michael McKee
We'll
from
probably get a
Bloomberg
couple
TV
more
and radio.
questions here during the.
You said that the
press
destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well,
yeah.
Just
That's a
talking
good
about demand
question.
for a second. As I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor
There's
market
some really
is
good
strong,
points that he's
and the economy
making
has gone
throughout
right through
these
that and been
responses
fine.
that I think
So
need to
that's
be
happened
compiled
many times
and
it
looked at.
used to
I'll
happen, if you
comment on a
remember, in
few
the
of
first
them at
quarter
the
of
end,
every
but
year for several years in a
there's
row,
some very
GDP was
significant
negative,
points he's making
and
here.
the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a
Make sure and
great
put some
deal of
questions
money
in over on the
people's balance
sidebar. I'd
sheets
love to get you
they can
guys'
spend.
feedback on what
The
you
unemployment
think
rate is very low.
Chair
The labor
Powell is
market's
doing. Is
very
he
high.
hawkish
There are
or
many
dovish
job openings.
on the way you're
Wages are
reading
high.
this
So
right now?
It's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing.
Traders in the
quarter.
house working
That does-
the
that is
charts
fairly
today.
broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running
Just
below
a
potential
quick answer there,
for a
Tarek. I
sustained
would.
period to create
It's
slack
just
in
is just a
and
thing I
keep
do all the
inflation
time. Get everything onto hardware wallets. That's my move. Is self-custody.
Hi, thank you, Chairman. Nicole Goodkind, CNN Business.
I don't trust any exchanges.
When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
Kind of a reiteration of the job he already
seeing,
or
you've
an
seen
answer
in the labor market
he already gave.
is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they
I would
appear to be
say
moderating.
he is
Not so
pulling
yet
on
from
the
other wage
neutral
measures, and we'll be getting the employment
position,
compensation index
but
measurement, I think, on Friday.
I still
And that's
feel
a very
that
important one because
within
it
all of
adjusts for
these questions, he's made some very
compensation.
significant
So
statements
I'd say you
lead you
also
into
anecdotally,
believe
you
otherwise. I
hear
still believe this is a
much,
bit more hawkish
the sort of
than dovish.
level of
and I'll explain why.
concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So
Yeah,
there's
David,
a feeling
I'm
that the
leaning a
labor
little bit
market
more
is
on the hawkish
moving
side, and
back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, I mean, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence.
There's
that's
a
the case.
reason for
seeing
that
much in
as
the way of
well.
labor
I'll
supply.
point that out, of
Nonetheless,
why we haven't seen
I would say
increase in
some-
labor
some
supply
progress
versus
on
labor demand.
Demand and supply getting back in alignment.
Yeah, a lot of key points here that he's made throughout
We're
the
gonna be looking
responses. I'm surprised he's given this many
at
answers, though.
inflation as well. We, you know, as I mentioned, we need to see inflation.
He's normally
coming
pretty
down.
tight on
We
these,
need to
and
be
we're actually
confident
rolling
that
up on the
inflation
hour
is going to get back
over
down to
304.
consistent levels.
He normally tries
That's
to
not
lock
something
these
we
down,
can
so that's a good
avoid
sign.
doing.
That's a good
that really
sign.
needs to happen. But we do think, though, that the labor market can adjust.
Of course, you could take it two ways. Is that
because
he's
of
trying to
huge
get
overhang
calm
of
in the
job
market,
openings,
so he's
of excess demand,
giving
really.
more
There
information.
should be able to be an adjustment that would have lower than perhaps
Abrupt
lower
meetings
than
are
expected
always, like, hey, we're
increases